Mukherjee into this conversation now. Udayan, hi, good morning. It's what, 8,300 to 7,600 in less than 2 months. That's the kind of ferocity of the fall we've seen. Where do we go from here?
Morning, Sonia. Well, it's a tricky time for the market, and the next few days are very difficult to call because you have some events stacked up which will probably lead to those 200-point kind of volatility for the Nifty. So it's very difficult to say what happens on Wednesday, Thursday from here on. You could have any situation. You could have a Fed rate hike, which the markets might respond to with a small relief rally, which I don't think will be sustainable. But you could get those 150, 100, 200-point kind of moves coming in on the Nifty, maybe even in the dollar rupee, and the market might revert after that quite swiftly. On the other hand, if there is a sign of distress from the Fed, it does not move, then you could see a bigger sell-off in global markets. Again, maybe 100, 150 points, no more than that. But even so, for traders, it becomes very important to map that in the near term. I think just in the near term, the important point to look at is, of course, the previous low that we made earlier in the year. And I think every trader will be watching that very, very closely on whether that gets taken out or for the moment the market lives to fight another day. So I think the near-term thought in the market or discussion in the market will hinge around preservation of the previous low on the Nifty. I think it was around 7,500 odd. I think a lot of the trader focus might hinge on that. In my view, it's not very relevant, but just in the next few days, it becomes quite relevant for a trader.
Okay. Hi, Udayan. Good morning and good to have you with us. Well, is the Fed event definitely completely digested and discounted other than probably 150, 200-point volatility? You think there won't be too many casualties in the fixed income or in the equity markets?
Morning, Datab. I think it's a non-event, frankly. But now it can become an event if the Fed did not move. But if the Fed does move, as most people expect, I think it's fully discounted long in advance of the event. And frankly, it will be a complete non-event for the market. I'm not even sure it moves the market by 150, 200 points if the Fed does move. I think the Fed is actually a bit of a backstory right now. But I don't think global market people or traders or investors are looking at or discussing the Fed as much as they're discussing the collapse in commodity prices. So I think it's been relegated to a bit of a minor story at this point in time. But having said that, the one thing which can render it an event is if the Fed chooses not to press the trigger, because Janet Yellen has painted herself into a bit of a corner with all the signaling ahead of the event, which has prepared the market for a rate hike. And now, because of the pressure which has been put on the Fed in the last few days with the collapse in crude and the junk bond and all the things which are swirling around, if the Fed panics now and says, I will wait and watch a bit more, this is not the time to effect a rate hike, then that might go down as a signal of panic in global markets, and I think it might set the stage for a bigger sell-off out there. So in my eyes, it's only an event if the Fed does not move tomorrow. If it moves, I think it's well discounted and therefore a non-event.
Okay, so the Fed is a non-event. So then good time to talk about individual stocks. So then, we were just having this banking discussion a couple of minutes ago, and some of these PSU banks have now become quite cheap. I mean, most of these banks, Punjab National Bank, Bank of Baroda, are trading at less than 1 time price to book. But even if you look outside the PSU bank space, even some of these private banks like Yes Bank have corrected quite a bit. How do you approach stocks like these?
With a little bit of trepidation, Sonia. It's true that the price point has changed quite a bit. But they're not looking very strong to me. You were just reading out ICICI Bank at 245. The price is not telling you a story where people are actually flocking to buy value in some of these private sector banks. On one hand, they might be having a technical problem because they're over-owned and that over-ownership has not corrected fully. And on the other hand, the very issue that you've been discussing, what the Reserve Bank wants to do, and in my eyes, absolutely fairly, is to ask the banks to basically own up to their problems and call a spade a spade. They've been hiding for far too long. And I think the RBI governor's messaging over the last 10 days has been very, very direct and consistent that he wants banks to make more disclosures and to provide more. I mean, he couldn't have said it more eloquently by using that phrase over the weekend in Calcutta where he said, God's judgment will fall upon unrepentant lenders. I haven't heard a more eloquent line in a long time. So, I think he will force banks to disclose more. Yes Bank does not. I just heard the analyst talking about how it doesn't have a very bad book, but it was very aggressive in expanding its book, and in doing that, it lent to companies like JP Associates, GMR, Lanco, Suzlon, SR, and those are sitting on its books. Now, for a small bank like Yes Bank, it's not just about what percentage is exposed to these kind of risky assets. Even if it's 4 or 5%, that's enough to drill a big enough hole in your numbers. So I'm a bit worried about Yes Bank, frankly. I know the stock was 900 and it's now 680, 690, somewhere there, or 670. So it's corrected quite a bit. But given the circumstances of this whole RBI direction and the discontinuities which technology will throw up for this space in the next 2-3 years, which is not an insignificant threat, I think the comfort valuation level for a bank like Yes Bank should be no more than 1.5 times book 1 year forward. 1.5 times book takes me down to 550, 560. Ooh. I'm not suggesting the stock goes there immediately, but it wouldn't surprise me if this market turmoil continues, that you can actually get Yes Bank at sub 600 levels as well. So I wouldn't be queuing up to buy these private sector banks right now. I've held that view for some time now, as you know, that there is a valuation contraction and an ownership correction which is underway. And looking at the price performance, it does not appear to me that it's completely done with yet.
So just to complete that argument, Udayan, if one is building a portfolio for 2016, I mean, nobody starts from scratch, but if one is building an incremental portfolio, do you avoid this 30% of the market, the financials? One, because the world is still deflating and contracting, and therefore you don't know how much more bad loans will come out of the woodwork. And also because technology is such a big disruptor. So avoid this 30% other than maybe an HDFC Bank?
It's almost impossible to do, Lata, for a fund manager, because you cannot avoid being benchmarked to 1/3 of the market. Because if it moves and you're left out of it, then you're completely out of the game. So a mutual fund manager or a portfolio manager has no recourse but to have some of the banking exposure. But the kind of exposure which portfolios have today in the financial space, that worries me a little bit, because this space has been underperforming for a while, which would be hurting most portfolios by now already. Also, these constant cries of buy every bank quickly because that is the space which will lead once again, I think is basically saying that history always repeats itself in the market, and everything which did well in the last 3 years will automatically lead the next 3 years in the market, which is the point that I've been trying to labor over the last few times, that this kind of investment pattern, looking at the rear view mirror, does not always reap very rich dividends. So I think it's not fair to say that you should have nothing in financials. But should you be terribly overweight financials? I don't think so. So you could still pick 1 or 2 banks. The point is that the price point is coming down. And as I said last time to you, if you get clean banks at lower price points, I think that's what you should be looking at. Because this is not a time to get attracted to the bad bank because of a rich valuation or because of a good valuation, because that good valuation is hiding a lot of things. So right now is the time, if you're owning banks, to move towards quality and actually pay a little bit more for that extra quality and not buy that broken, beaten public sector bank for 0.5 times book because it's showing you 0.5 times book on the ticker tape.
Okay, by the way, the bank Nifty is now under intense pressure. It's down almost 0.8% and underperforming the markets quite a bit. And all of these banks are taking it on the chin. PNB, ICICI Bank, Kotak are all down more than 1%.
I think in that entire conversation of Mr. Gupta, the SBI Managing Director, while he clearly was not willing to give away anything of their dialogue, and of course it's an inconclusive dialogue, it's work in progress, he did say that we have to provide more.
Yes.
That was there. So I guess now that's a further confirmation that earnings and book are going to look worse than what people factored in.
Okay, let's move away from banks and talk about, some of the other stocks that are generally barometers of the way the capex cycle moves. So L&T, for example, I mean, it's lost 35% of its value in just less than 6 months. 6 months ago, it was at 1900 and now it's closer to 1250. Investors have gotten quite frustrated waiting for the capex cycle to turn. That has not happened. So what do you do with a stock like L&T?
Sonia, the way L&T is getting bashed up, I think it's not entirely to do with the capex cycle. I know that is top of discussion when L&T moves. I think L&T is now becoming an oil sensitive, and the reason L&T is getting pasted is the way oil has collapsed. And there are two ways where L&T gets hit because of oil. And I think today the L&T managing director would be terribly worried about this collapse in crude prices, because in one hand, a significant part of its business, the hydrocarbons business, and you should just go back and see in the last 5 to 7 years how much of L&T's business actually comes from companies like ONGC, Cairn, Oil India. It's a significant chunk of its business. And I do not see how ONGC is going to do capex over the next 2 to 3 years the way crude has crumbled. That presents itself with a fairly significant threat in terms of order booking. The other is what's going on with the Middle East and L&T's export book. The Middle East is an important part of L&T's export book. And again, capex and execution cycle in the Middle East will get affected quite significantly, I would imagine. It's intuitive after the kind of battering that crude has taken. So it does not exactly follow, and people don't think about it in as many terms. But I think L&T is an oil sensitive at this point in time, and for a company which has already rung a few alarm bells about order booking going forward, this twin problem of the export market plus the hydrocarbon sector, I think could lead to a little bit more of a technical hangover over their L&T company, L&T stock. I think a lot of people are actually cutting their weightage in L&T because it's always been one blue chip that you own in your portfolio. And like private sector banks, I wouldn't be surprised if you see that this quarter L&T's ownership has actually gone down in the hands of a lot of institutional holders. Now the question that you started with, has the stock corrected enough? It was 1900, now it's 1250. So obviously the prices are much lower and some of these negatives are in the price. But, just looking at valuations, the way L&T is going, I don't see it doing more than 62, 63 rupees earnings. I know consensus might be a bit higher in 2017. Which means even after the correction, the stock is trading at 20 P multiple. 20 is not a small P multiple, given a stock which is beleaguered with so many problems or beset with so many challenges right now. So I think L&T can lose a couple of percentage points, a couple of points on the PE chart quite effortlessly, bringing it closer to its longer term PE multiples. So maybe 1100, 1150 is a point where you want to look at L&T. And could the stock go there? I think absolutely.
Okay, let me come to the other big space which people have wanted to own in the Nifty, the auto space. There is a green cloud hanging over all of them, in some cases more dense, as in the case of M&M. Should one use this time and this conversation period to buy these stocks on the expectation that in any case you cannot ban diesel in India just yet, or should we wait for them to get cheaper?
That's a matter of timing, which I'm not very good at, Lata, or I think that's, you could always average down. But I think auto is a space where we should own some stocks. So you cannot just say that I will not buy autos in India, because longer term demand patterns are quite significant. They might be going through a bit of a softish patch right now, but I wouldn't worry overtly about it. It's just that what do you want to buy in autos? And in that, my only theory is that you should actually buy pure plays in auto. Don't buy conglomerates who do a lot of things. You want to buy commercial vehicles, buy a clean commercial vehicle play like Ashok Leyland. Not very expensive. It's corrected again to 85, 86 kind of levels. May have fallen a little bit more. But the cycle will turn. Ashok Leyland is in a nice place to play that upcycle whenever it starts. It's not terribly expensive, trading at just about 15, 16 PE. Play a pure play there. You want to buy two-wheelers, play a pure play two-wheeler company like a Bajaj Auto or even a TVS Motors, which is not very expensive at this point in time. Those conglomerates are a problematic thing. Tata Motors, some people say, I want to buy Tata Motors because the CV cycle is turning up. That's 15% of Tata Motors revenues. That's not very significant. Tata Motors is actually almost a pure international car play. Do we understand the dynamics of the Chinese JLR market, Chinese car market? I can't profess to be one, and therefore I'm not very sanguine when people say JLR's metrics are looking very good in China and therefore you should go out and buy Tata Motors. So Tata Motors is a stock which I'm ambivalent about. I don't claim to understand it, and therefore it springs surprises on lots of investors. So I'm not in that group which believes that Tata Motors has bottomed out. There's too many straws floating around in the global landscape right now, business landscape as well, not just market. So I would probably look at Tata Motors with a bit of suspicion, despite the recent correction in the stock price. M&M is good. It's corrected quite a bit. It's not terribly expensive. It's made an interesting acquisition. I don't know why they had to saddle Tech Mahindra with it. It was a car company. They should have just bought it on their own. But I think the tractor market will slowly start lifting up. They're trying to address the SUV problem. So M&M is a good management. In the longer term, it probably makes sense. So short story, yep, you can buy Leland. You could probably buy one two-wheeler. You could start sniffing at M&M. Maruti is overowned. It's very good, but it's overowned. And Tata Motors, probably stay away for the moment.
All right, Udayan, that was a very enriching conversation. Thank you very much for joining us on that bunch of macros and sector analysis. The Bank Nifty has taken your conversation, and I guess even Mr. P.K. Gupta's conversation very hard. It's down almost 1% at this point in time. So Bank Nifty under a spot of bother. Nifty as well down about 0.2. Let's take a quick break. We haven't done that in a bit. We'll come back. Moody's has maintained their stable rating outlook on India. A lot of macro numbers were announced. Atsi Seth of Moody's Investors will join us in a minute.